With the name of Allah, the most merciful and the most beneficent. Subject is financial statement analysis. In today's topic is on leverage ratio. Today we will discuss leverage ratio or what is called debt ratio. What are leverage ratios formulas. Then we will explain these ratios with the help of illustration. Then we will also discuss that how to interpret these ratios. Now, what are leverage ratios? Leverage ratio is any of the several financial measurements that look at how much capital comes from the debt and also assess the company's ability to meet its financial obligations. So in debt ratio, we will see that how much capital is from debt and how much is from equity to finance the assets, and how much is from equity. So leverage ratios are revolving between the combination of these two things. Leverage ratios is important, or its significance is clear because the company assesses its ability to meet long-term financial obligations, that is principal amount as well as interest. The second significance of the leverage ratios rely on the mixture of equity and debt to finance the operation. In knowing the amount of debt held by the company is useful in evaluating whether it can pay off its debt as they come due. So this is basically how the company going to prepare a budget to pay its long-term obligations. Then when the loan is useful, when should the company have to borrow or to finance its asset through debt rather than on equity? There is very simple formula. If the company can earn higher rate of return than the interest rate, then it is useful or helpful for the company to get loan and exploit the opportunity and earn higher rate of return. When the company earn higher rate of return than the interest rate, the company will be able to pay interest rate back to the borrower as well as some of the earning will be used for the growth of the company. So there is simple formula. When the company can earn return greater than the interest, then they should opt for taking debt in order to finance its operation. Otherwise, if the return the company earns is less than the interest, then it is not good for the company to borrow a debt at a higher rate and then earn a lower rate on these borrowing. So it will have negative impact on the growth of the company. Then what are leverage ratios? There are different authors quoted different leverage ratios and categorize them differently, but main factors that are to be considered in leverage ratios are debt, amount of debt on the balance sheets, then equity, on the balance sheets, then asset on the balance sheet, interest expenses from that of the um, from that of the income statement or profit and loss account. So the are some important ratios that will be discussed in this lecture are debt to equity ratios. Debt ratios are equity multiplier. We will also discuss long-term debt to equity ratios. Then the fourth one is time interest earned, or this ratio is also called interest coverage ratios. Then the fifth one is debt service coverage ratios. So this is graphically we can say these are assets of the company. These are assets. And how it could be financed through, let's suppose this is equity. This is, let's suppose, debt. This is, maybe we can say that there is leasing option or preferred stock or any leasing, or may called some other sources which may be called preferred stock. So these are different sources of finances to finance the assets, and this is the leverage that we used in physics. But now we will discuss it that these are the forces that could be put in order to raise the assets of the company. So this is different combination of the finances, which is called, so this the whole phenomena is called, the relationship between these things are called leverage ratios. Now debt to equity ratio. What is debt to equity ratio? Debt to equity ratios can be computed by dividing company's total liabilities by its shareholder equity. These numbers are available from the balance sheets and company's financial statement. So debt to equity ratio is equal to total debt plus value of lease divided by average shareholder equity. So debt to equity ratio include both one total debt, borrowing of the company, as well as how much assets are get through lease or financed through lease divided by average shareholder equity. Average shareholder equity can be computed as at the beginning and at the end of the year divided by 2. This equity figure do not remain constant. So it is also possible that the company may issue new shares during the company, or it may earn some, the earning of the company also change the amount of the shareholder at the beginning and at the end of the year. So we will get average of the beginning and ending figure of the shareholder equity, then divided by 2, we will get average shareholder equity. What it measures, this debt to equity ratio measures the degree to which the company is financing its operation through debt versus wholly owned funds such as equity. It also give signals about that how much the company is financing its operating assets or its operating activities or activities through debt as well as through its own fund. Uh, some figure may contain individual account that would not normally be considered debt or equity. In the traditional sense of the loan, the book value of the asset. The ratio can be destroyed by retained earning or losses, and tangible assets such as goodwill as well as um, um, intangible assets means goodwill, copyright, license, patent, etc. And some liabilities which also destroy this ratio are pension plan of the regarding the employees. So this pension plan or pension liability is also liability of the company, but it is not liability of such as debt of the borrowing from the bank or the lease agreement, because this pension liability do not mature at once at a time. So further research is usually needed to understand the company's true leverage. So this is basically criticism on this debt to equity ratio. So we will further also discuss some other ratios that would address these issues. Now, debt ratios are equity multiplier. Debt ratio is a financial ratio that measures the extent of the company leverages. The debt ratio is defined as the ratio of total debt to total assets rather than debt divided by equity, expressed as a percentage. So debt ratio is equal to total debt divided by total asset. It doesn't include value of lease. Higher ratio indicate that the company may putting itself at risk, because when there is a higher ratio, higher ratios indicate that there is higher debt. Higher debt means higher risk of default on its loan if interest rate were to rise suddenly. So this high ratios is not a good sign, because higher ratio indicate the debt and there is increasing debt in the company, and increasing debt also result in risk of default. Debt ratio vary widely across industries, because capital intensive businesses such as utilities or pipelines having much higher debt ratio in the other industries such as technological sectors. So when there is a need to have huge assets, then the company will be called capital intensive company. They implied a higher debt ratios or higher debt as compared to those companies who do not need any tangible huge assets such as technological companies. So it varies across the industry of the country. Now, long-term debt to equity ratio. Long-term debt means ratios is a leverage ratio comparing the total amount of long-term debt. It doesn't include short-term debt of the company against shareholder equity of the companies. Long-term debt equity ratio is equal to long-term debt divided by long-term. Why long-term debt? Because these current liabilities such as account payable, or any other short-term liability do not carry any interest cost to the or financial cost to the company, so it is excluded in this ratio divided by average shareholder equity. As we discussed, that average shareholder equity is the amount can be computed as that the started of the beginning and then ending divided by 2. So the goal of this ratio is to determine how much leverage the company is taking. Higher ratio means the company is taking on more debt. This is in turn often make them more prone to financial risk. So this higher ratio means higher long-term debt. Higher long-term debt means higher higher risk of default. So financial risk is high if the long-term debt to equity ratio is high. And then long-term debt to equity ratios is a variation of debt to equity ratios. Debt to equity ratio takes into account short-term debt, long-term debt, and other fixed payment. This is one of the kind or one of the derived formula of the debt to equity ratio. But in debt to equity ratios, we take short-term debts, long-term debt, and other fixed payments such as lease payment. But in this case, we cut this one, and this one we will include just this long-term debt in these ratios. Time interest earned or interest coverage ratio. It measures company ability to meet its debt obligation on periodic basis. The ratio can be calculated by dividing earning before interest and taxes by its periodic interest expense. It's also called interest coverage ratio. Why EBIT? Because this in EBIT is the income that is available to borrowers and other stakeholders as well, such as government, the tax authority. And so we will use earning before interest and tax. Time interest earned is equal to EBIT divided by interest expense. This ratio shows the number of time that the company could theoretically pay its periodic interest expense should it devote all of its EBIT to debt repayment. If we assume that all EBIT is used to pay interest expense, how much we can pay? How many times we have more EBIT to serve our debt or to serve our borrowings. High time interest earned means that the company have very low probability of default on its loan, making it safer investment opportunity for debt provider. The high time interest earned means that the company have more huge earning in order to satisfy the debt provider. So if the company have high time interest earned, then the investor may see it is an opportunity to invest in that company because there is a safer investment. Debt service coverage ratio. Uh, it is also called debt coverage ratio. Is the ratio of operating income available to debt servicing for interest and any other principal or lease payment. While this is the difference, there is a slight difference between this and debt service coverage ratio and interest coverage ratio. In interest coverage ratio, we will use just consider this interest payment, but in debt service, we use principal amount and lease payment as well. So debt service coverage ratio is EBIT divided by total debt services. It is one of the popular benchmark used in measurement of an entity's person or corporation ability to produce enough high cash to cover its debt, including lease payment as well. What high ratio communicate in this case? It is easier to obtain a loan if the company have higher debt coverage ratio. It means it have low probability of default. Default risk is low, so the company will be in better position to obtain loan from the debt provider. The phrase is also used to in commercial bank and may be expressed as minimum ratio that is acceptable to the lender. It may be loan condition. Some of the bank use this ratio is minimum ratio, mean the bank banks keep some threshold for this ratios in order to provide debt to the companies. Leverage ratio illustration. Now we will discuss these leverage ratio with the help of illustration. Again, we will continue the same example of Quad Cement Company Limited. This is the balance sheet of the company. This is authorized capital. This is which is not used in any calculation. This is issued and subscribed capital, reserve, accumulated profit, that is total equity for 2010 and total equity for 2009. Average equity will be summation of these two divided by 2. Now, this is long-term non-current liabilities. Long-term finance secured liability against assets subject to finance lease in 2009, but in 2010 we have no finance lease. Long-term security deposit and retention money. In both years we have approximately the same amount. Deferred liabilities, deferred taxation, etc. Derivative financial liabilities, which is so total liability of the company is this amount. Current liability, trade and other payables, interest and markup accrued, short-term borrowings, current portion of non-current liabilities. Now come to the asset sides. Non-current asset, property, plant and equipment, fixed assets, capital work in progress. This is total tangible assets. Intangible assets is this one. Long-term loan and advances to other people and long-term deposit with the bank. This is also long-term assets. Now current assets are that is which is called store and spares, inventories, account receivables, cash and cash equivalents are near to cash assets, that is cash and bank balance, that is total current asset, that is total long-term assets, that is total asset. Now we will discuss we will discuss this income statement here. We will only be interested in interest expense, which is called finance cost. This is finance cost. This is finance cost for the, which is in other words called interest expense. So we will calculate our first ratios. Based on this balance sheet, we are required to calculate debt to equity ratio, debt ratio, long-term debt to equity ratio, time interest earned, debt service coverage ratio. So debt to equity ratios, we will plug the value in the formula is, this is debt which we get from balance sheet. This is debt and this is equity, which is 1.7. Debt to equity ratio means debt, total debt divided by value of lease divided by average shareholders equity. So this amount comes from value of lease in total debt, and this is come from average equity. So that is 1.57. KCCL implied more debt than its equity financing and consider high leveraged firms because it is capital intensive company, so we cannot give any opinion or any interpretation when we compare this quad cement with any other cement of the same location such as Lucky Cement, or when we compare it with the industry averages, then we will be in a better position to give any opinion about the bad or good of this debt to equity ratios. Debt to equity ratios. Now we will discuss this one. This is debt ratio, total debt divided by total assets. This is total debt of the company, and that is total asset, which is 0.40. KCCL assets are financed through 40% assets are financed through debt financing, while 60% through their own fund. Long-term debt to equity ratio. Now, long-term debt to equity ratio, long-term divided by average shareholder equity. We will plug in the value in this formula. Where we get these values, we will get this value from the balance sheet of the KCCL Quad Cement Company, from its long-term debt portion, and this is the average equity of the shareholders, that it is computed through by adding the equity of the both year and then divided by 2, which is 1.765. This ratio is same as debt to equity ratio because there is no lease liability in 2010. Now time interest earned or interest coverage ratio. Interest coverage ratios can be calculated as earning before interest and tax, then interest divided by interest expense. By plugging this value from extracting the value from the balance sheet of the Quad Cement Company Limited, this is we call earning before interest and tax, and this is interest expense, which is 0.4196. KCCL is not earning sufficient to cover its interest charges. So how they will bear these interest charges? We will dig deep to investigate the company other assets in detail. Thank you. This is all about today lecture. See you in a coming lecture.